Hello everybody and welcome back to this second video in our solar series where we have selected some very interesting and different types of companies to run over. So the first four companies that we have are primarily manufacturing solar panels. We have here JinkoSolar, stock ticker JKS. We have Canadian Solar, stock ticker CSIQ. These ones are probably the two biggest companies among the five. We have Enphase here, stock ticker ENPH, which is probably the most well-run solar company that we have touched so far. We have an upcoming one here, ReneSola, stock ticker SOL. And finally, we have Daqo Energy, I think that's how it's pronounced, stock ticker DQ, who is providing polysilicon. So they are providing one of the key ingredients to manufacture solar panels, and it's a really interesting company. So obviously we want to first understand whether these companies are in an uptrend or a downtrend. So we can take a look here on the performance for the most recent periods, and similar to the other solar stocks that we ran over in the other video, these have been on fire. So we can see year to date, JKS has gone up with 182%, CSIQ 78%, ENPH 348, really good, SOL 175, and DQ 316, so really good numbers. So first we obviously want to understand whether these companies are earning any money and they are making a profit in the end of the day. So if we take a look at the net income, we can see that all the companies, with the exception of Sol, is having a positive net income. The one that sticks out quite far is when we look at the net profit margin, where you can see JKS has a small 2.77%, CSIQ 5.20, not that good. Then you go to Enphase, whoa, almost 25%, by far the best that we have looked at so far. So if we go up to look at the revenue, we can see that JKS is almost 7 times bigger in terms of revenue than Enphase, but Enphase is earning more money than JKS. It's a really, really good number, really, really strong performance. Then you have Sol here, which has a minus 8.35, again not that good. However, as we can see, they have a small revenue here and they are probably in a more growth phase than some of the other companies. Finally, you have DQ here, which actually has 11%, so that's quite okay. We can also look at the Beanish M-score, which is just a mathematical model that determines whether a company has manipulated its profit. We want this to be below minus 2.22, and we can see all of them, with the exception of Sol, are living up to that. However, they have minus 1.98, so it's still quite okay. We can also take a look at the Sloan ratio, which identify if a substantial part of earnings are non-cash accruals, and we are obviously not interested in that. So we want a number between minus 10 to 10%. We can see JKS just falling out. CSIQ and ENPH are in the green zone. Sol, again here, a small red flag, 24.50 minus, and DQ is looking quite okay. So first we looked at the trend, and what we could see from all the companies are that they are in an uptrend. We would say that for JinkoSolar, if we look at the simple moving average for the last 20 days, that points to a downtrend. However, we don't feel that that is sufficient to call a more permanent downtrend state, so we still see it as being an uptrend, also considering that Biden just got elected for president. If we take a look at the net income, 4 of the companies were positive. ReneSola was the only one that was negative. On the net profit margin, Enphase were much better than the rest. ReneSola was the only one losing money as of today. We then move into the return metrics, and we want to understand how high returns and cash flow margins is being generated by these companies. So if we first take a look at the ROIC, the return on invested capital, benchmarked against the industry, these ones fall under the semiconductor industry. We can see that both JinkoSolar and CanadianSolar are doing not that well here with 3.5%. Enphase standing out again with almost 39%, really strong number. Sol actually doing quite okay compared to what I would expect, on around plus 5%, and DQ doing the worst with around 2.5%. If we took a look at the levered free cash flow margin, JinkoSolar again a bit disappointing here with minus 5%. It's looking much better for CanadianSolar with around plus 10%. Enphase again looking really strong here with almost 30%. Sol, very surprising, 39%, really strong number. And DQ again disappointing with having the worst on around minus 8%. We then move into the balance sheet section, and we want to understand how strong the financial position are of these companies, especially for the ones that are losing money. So first we can look at the current ratio, which we would like to be above 1, and we can see that both JinkoSolar, CanadianSolar and Enphase are living up to that. Enphase really good here with 3.31. Sol doing respectively with 0.90, not that bad, it could be worse. A little bit disappointing again here with DQ, who only has 0.47. We can also look at the cash ratio, and we would like this to be above 1. So there are some red flags here with JinkoSolar and CanadianSolar, but I would say, JinkoSolar still has around 2 billion in cash and short-term investment. CanadianSolar has around 1 billion, so it's still quite okay in the end of the day. But Enphase, compared to its size, is again doing the best with 2.58. And for Sol, they only have $12 million, and they were losing $11 million the last year. They probably need some money to grow further. So again, this is an indication that this company may need to issue more equity to fund their growth going forward. So it's a bit of a small red flag here. And DQ again has 115, but it's not really that good number. We can also take a look at the total assets versus total liabilities. We want that to be above 1.5. We can see all of them are close, if not above 1.5. So again, no worries here. Similar story with the debt equity ratio. All of them are having really solid numbers, so no concerns on our side with them. The Altman Z score is a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8. We can see that JinkoSolar and CanadianSolar are not living up to that. However, I am not too concerned with these companies. Enphase looking really strong here again with 15. Absolutely no concerns with them. Sol has a minus 0.92, so again a small red flag on their balance sheet compared to how much revenue and money that they're losing in the end of the day. DQ actually doing quite well here with 4.15. Similar with the Piotrowski score, it's another way to assess the strength of the company's financial position. We want this to be equal, above 5, and all companies with the exception of Sol, no surprise, are looking quite okay. So moving back to the overall ranking, we then looked at the return on invested capital, and here there was no doubt Enphase were by far better than the rest of them. ReneSola, JinkoSolar, CanadianSolar was not doing too well, and Daqo was doing even worse. Close to similar situation on delivered free cash flow. However, here Sol was doing really well, the best, followed by Enphase. On the total assets, total liabilities ratio, all companies were looking really fine, so there's no concerns with any of them. And the same situation with the debt equity, all companies are looking relatively solid. We then move into the shareholder yield section, and then we usually would like to understand how much value is returned to shareholders, but for these companies who are in a growth phase, we are not expecting any dividend, which is also the case for all of them. We are a bit more interested in the buyback yield section because some of these companies needs to issue more equity for their growth or to cover their losses. And as we can see across the board, with the exception of CanadianSolar, all of the companies over the last 12 months has issued new shares, and Sol is the one having the highest. Again, no surprise given that they are the company who at the moment are losing money. We can also take a look at the earnings per share and growth, and we basically want to understand whether these companies are expected to grow in the future. So this is probably the most interesting section to look at for all these companies, and we can first look at the PE ratio, and we can see JKS and CSIQ are actually quite interesting here. They're between 9 to 15. Enphase a little bit higher on 24. Sol we do not know obviously because they have a negative PE ratio, and DQ has 51. So all of them are attractive compared to the industry, but we would say that DQ looks a little bit high. Another one that is very interesting to look at is the price to sale ratio, where obviously JKS and CanadianSolar are very low here with 0.61 and 0.73 compared to Enphase, which has 20.20. So basically this means that you're paying a high price compared to the revenue. The flip side with Enphase is obviously that they're so profitable compared to these companies. They're generating the same profit in the end of the day with much less revenue. We also want to look at the earnings per share growth forecast for the next 5 years. And what we can see here is that JinkoSolar seems to have stagnating a bit, only 5%, so not that high and less than the industry, while as CanadianSolar, Enphase and DQ are looking really well with between 20 to 37%, and Sol not the worst but neither the best, around 15%. If we take a look at the revenue growth for the last 12 months, we can see that JinkoSolar, respectable 19%. Red flag here on CanadianSolar, they have lost 33%, so quite a high number. Enphase has had more or less stagnant for the last year with a -1%. Sol, as expected, they're growing a lot from a small revenue part on 93% growth, and DQ has also done really well with 103%. So we want to hold that against the net profit growth for the last 12 months. So we can see here that JinkoSolar has increased their profit growth with 258%. So although the revenue has not grown like crazy, they have become a lot more profitable, and that's obviously very important to know. A similar story again with CanadianSolar. They have grown with 157%, so they have maybe preferred to get net profit growth over revenue growth. So it could be that they have increased their pricing. So again, they have not sold as much, but on the other hand, they have earned more per product. Enphase again, almost 5,500%, so extreme growth over the last year, and that's probably one of the reasons why the stock has been shooting up so much and why they're earning so much money based on such a little revenue. Sol again, -27%. Again, not too surprising. They are small companies, so they are probably preferring to just grow some revenue rather than being profitable at this stage. So I wouldn't see that as a huge red flag. And then we can look at DQ has also been doing extremely well with 203%. So across the board, I would actually say that all these companies are posting quite good numbers on a different parameters. In general, they are all heading in the right direction. So back to the overview, we could have looked at the price to sales ratio. However, we didn't feel that would be the right evaluation for these companies, and it would be a little bit misleading with Enphase. So we decided to look at the earnings per share growth forecast for the next 5 years, and what we could see here was Enphase doing the best, followed by DQ, CanadianSolar, ReneSola, and finally JinkoSolar. On the revenue growth for the last 12 months, Daqo had been doing the best, followed by Sol, followed by JinkoSolar, Enphase and CanadianSolar. On the net income growth, Enphase had by far doing the best with around 4,500%, followed by JinkoSolar and Daqo. Finally, we obviously want to understand whether these companies are currently under or overvalued, and we have different ways to look at that. One way is to look at the PEG ratio in accordance with Peter Lynch fair value, and basically what that tells is if the PEG ratio is below 1, it means that the companies are undervalued. If it's above 1, they are overvalued. And what we have seen in a lot of our videos is that most companies are overvalued from this perspective. However, what is very interesting to see here is that both CanadianSolar and Enphase are undervalued from this metric perspective, and that's really intriguing, while as JKS and Daqo are overvalued, and Sol we cannot because of the negative PE. We can also take a look at my own estimated intrinsic value of these companies, which is based on a lot of different numbers and parameters, and what we can see is that there's a fair value downside estimate on JKS on around 24%, 11% on CanadianSolar, 17% on Enphase, 24% on Sol, and 11% on Daqo. So from my perspective, all these companies are currently overvalued. However, there is obviously uncertainties related to these numbers. We can also just take a look at the beta ratio, which just shows the stock's volatility in relation to the overall market. If it's above 1, it's more volatile. And as we can see here, all companies with the exception of Daqo is more volatile than the general market. We can also look at some other value indicators. One of them is the book value per share, and here if it's above 1, they're considered undervalued. If it's below 1, they are overvalued, and all companies are overvalued, which is not any surprise. We can also look at the relative strength index for the last 14 days. We want this to be below 30 because it means that it's oversold and it may go in an uptrend. On the other hand, if it's above 70, it is considered overbought and it may do a pullback. All companies are, I would say, in not clear direction yet. They are in the 50 to 60 mark. So none of them are definitely in oversold territory, but they are neither in overbought. Finally, we can also have a look at what the analysts are saying. And again, you need to be cautious with them because they sometimes have their own agenda. However, I always think it's good to have a check at this, because if their story is telling the same as my own story, that gives some comfort sometimes. So we would like to look at the consensus price, which is just the middle ground of all the estimates. Some analysts will have a higher price target, some of them will have lower. And according to them, JinkoSolar has a downside on massive 65%. CanadianSolar downside on 16%, Enphase a downside on 13%, Sol has a small upside on 2.5%, and Daqo has a downside on 37%. So for me, okay, I have some of similar numbers to these analysts. However, I would say that some of them seems very aggressive on the downside estimate, especially with both JinkoSolar and Daqo. So finally, we looked at the intrinsic value of these companies using different parameters, and our overall value assessment is that these companies in the short term are considered overvalued. This doesn't mean that they're bad companies. It doesn't mean that we don't like them. It just means that they maybe have increased in share price a little bit too much too fast, and we therefore have a concern that they may experience a pullback once reality kicks in. There's no guarantees of that, but that is just what we are feeling based on the different parameters that we are looking at. So it seems like in our most recent video with electric vehicles that people appreciated the way we did our top pick or run through of all the companies. So we will do that again today. And what we will say is that almost all these stocks looks attractive in the long term. They have good, solid fundamentals. Some of them are a little bit more risky than others, and we will come through that in a minute. However, fundamentally, a lot of them actually looks quite good. So if we first look at JinkoSolar, it's an interesting growth opportunity. However, specifically for them, we would say wait for the dip. Right now, they are not the ones who are showing the best numbers, so therefore they would not be our first priority, but in general they still look like an interesting company for the long term. The next one that we have is CanadianSolar, who has become profitable at the expense of their revenue. What we see on CanadianSolar is that there will be a huge upside on this company if they can manage to grow their revenue again. with Biden selected as a president, although the Republicans may control the Senate, we do believe that solar will continue growth over the next 5 to 10 years massively. And a company like Canadian Solar will be able to take advantage of this. So we think that this stock, considering how much more profitable that they have come, we believe that they can reverse that and they will be an attractive opportunity in the future. It's probably the one compared to the price today that we see the best risk trade-off compared to the price. So a really interesting stock. However, there's no doubt that the best company among the bunch, and probably the best one we have evaluated so far, is Enphase. They have really strong fundamentals. They have managed to grow revenue. They have managed to grow profitability. I mean, earning the same amount of money with 7 times less revenue is quite outstanding. And we would therefore definitely recommend them to be bought for the long term. We have really high expectation for them. We would say that you are also paying 7 times as much on the share price compared to, for example, Canadian Solar. So the question is whether Enphase can continue the growth that they're on at the moment. We believe that they can do. However, we want to make it really clear that you're also paying for this as of today. They are a little bit more expensive than the others. The most risky or speculative play is probably Sol. They've decided to grow revenue at the expense of profitability, and they do not have an extreme good balance sheet, so it is a risky play. However, we do think there is a huge upside on this company. This could be a multi-bagger if they manage to continue the revenue growth and if they manage to become profitable. Again, the company is only 200 million worth as of today. So if they can really get the pieces together, this could be a huge growth stock for the future, but it is a bit more for the ones who has a higher risk appetite. Finally, we have Daqo, which has shown great revenue and profit growth. However, they do not have that strong balance sheet, but they are still profitable as of today. So we would say with them, wait for the dip. However, we also think that these will be a good long-term play. As we say, they are providing polysilicon in the Chinese market, and the Chinese market is expected to see huge growth in the coming years within the solar industry. So we think that Daqo is positioning themselves well to grab this increased market. So again, a good buy, but wait a bit to see if there comes a dip before you move in on them. So again, this is all we had for today. We really hope that you liked this video. Please subscribe for future content. Please like the video. Please provide a comment in the comment section. We always appreciate that. Please note that we are not professional financial advisors, and this is only for entertainment purposes. Hope you liked the video. Look forward to see you next time. Stay tuned and stay safe. Have a nice weekend. Bye.